A 95-year-old man wakes up every single morning in the same house he bought in 1958. A house that cost $31,500 back then when gas was 25 cents a gallon and nobody had heard of the internet. He drives himself to McDonald's for breakfast every single morning, orders the same thing, then goes back home and does something extraordinary. He reads for hours. Financial statements, annual reports, shareholder letters at 95 for fun. And his net worth? Roughly $150 billion. That's Warren Buffett, the greatest investor in human history. And here's what makes him genuinely fascinating. Not just the money, but the contradiction sitting right at the center of everything he says. Because if you walked up to this man today right now and said, Warren, I've got $10,000. What do I do with it? He would look you dead in the eye and say, buy an index fund. That's it. No stock tips, no insider knowledge, no secret formula. Just buy an index fund and leave it alone. But here's where your brain should short circuit. Because this same man in 1999 told a reporter he could guarantee 50% annual returns on $1 million. 50%. Guaranteed. His word. And then at age 93, he said it again. So which is it? Is the greatest investor alive hiding the good stuff from you? Is the index fund advice some kind of gatekeeping? Or is there something deeper going on here that Wall Street definitely doesn't want you to figure out? That's exactly what we're breaking down today. And I promise you, by the end of this video, both statements will make complete sense. And one of them is going to change how you think about your money forever. Let's get into it. Warren Buffett didn't just say to buy index funds. He wrote it into his legal documents, his actual will. In his 2013 Berkshire Hathaway shareholder letter, and by the way, these letters are legendary. People study them like textbooks. He described exactly what should happen to the cash left for his wife after he passes. His instructions to the trustee were this: put 10% in short-term government bonds. Drop the other 90% into a low-cost S&P 500 index fund. He specifically named Vanguard. Read that again. The man who built one of the most valuable companies on the entire planet through decades of genius-level stock picking looked at the question of how to protect the person he loves most, and his answer was the most boring, most basic, most available to anyone product in all of finance. Not a hedge fund, not a private equity deal, not some complex derivative strategy. A Vanguard index fund. The same thing your HR department offers in your 401k. The thing finance influencers on social media call the lazy investor's choice. Now, is this him going soft in old age? Is he just keeping it simple for his wife? Absolutely not, because he didn't just say it, he bet money on it. The world is financially melting down, and Warren Buffett decides right at that moment to make a very public, very specific wager. He challenged a hedge fund firm called Protege Partners to a 10-year bet, $500,000 on the line. The terms were simple: a plain, boring, do-nothing Vanguard S&P 500 index fund versus a hand-picked basket of 5 elite hedge funds managed by some of the smartest, highest-paid money managers on Wall Street. These hedge funds had everything: armies of analysts running quantitative models, access to data that normal investors can't even see, fee structures that only made sense if you were printing money, every possible competitive advantage. The index fund had one strategy: own 500 companies, charge almost nothing in fees, and literally do nothing else. 10 years later, and I want you to really sit with these numbers, the index fund returned 125.8%. The 5 hedge funds, they averaged 2.2% per year. One of them, elite, premium, hand-selected funds, returned a total of 2.8% over the entire decade. Let's translate that into real money, because percentages are abstract. $1 million in those hedge funds became roughly $1.22 million. Fine, right? That's profit. That same million in the index fund, nearly $2.85 million. The hedge fund manager didn't even wait for the 10 years to end. He conceded early because the math was humiliating. Now, Buffett didn't do this to be petty. He did it to prove a point that he has been making for decades. After fees, after all the complexity, after all the genius professionals cannot reliably beat the market. And if the professionals can't do it, the people whose entire career, their whole identity, is built on picking the right stocks, what does that say about the rest of us? This is why Buffett says the index fund isn't the participation trophy. The index fund is the trophy. Okay, so you're convinced. Index fund. Got it. Let me open my brokerage app right now. Stop. Not so fast. Because before Buffett would let you put a single dollar into anything, he'd ask you one question, and your answer might completely change where this conversation goes. Do you have credit card debt? At a 2020 shareholder meeting, someone asked Buffett almost exactly the same question you're probably asking, and his answer had nothing to do with stocks or funds. He said, if I owed any money at 18% interest, the very first thing I would do with any cash I had is pay it off. And then he added the line that should be printed on every credit credit card ever manufactured. I don't know how to make 18%. The man who compounded money at roughly 20% per year for 6 decades, the single best sustained investing track record in recorded human history, is telling you flat out that he cannot reliably beat your credit card's interest rate. Think about what that means for your $10,000. Paying off a credit card charging 24%. APR is a guaranteed return of 24%. No risk, no volatility, no waiting, no taxes on the gain. Instant. Done. There's no stock on earth that offers that. No fund, no crypto, no real estate seminar sold from a rented Lamborghini. Nothing comes close to a guaranteed, risk-free 24% return. So, if any part of your $10,000 is sitting next to a credit card balance, Buffett's answer is crystal clear. The debt eats first. No debate. All right, debt handled. What's next? Cash you can actually reach without touching your investments. Buffett has always been obsessed, and I mean genuinely obsessed, with never being forced to sell at a bad time. For Berkshire, that means keeping billions in cash reserves. For you and me, that means an emergency fund. 3 to 6 months of living expenses, sitting somewhere you can access it immediately if life decides to throw something at you, job loss, medical bill, car breaks down, whatever it is, you need a buffer so that a bad month doesn't turn into selling your investments at the worst possible moment. And here's some actually good news for once. In 2026, boring cash is finally paying you something real. High-yield savings accounts are sitting at 4 to 5% right now. Short-term treasury bills are in the same neighborhood. For the first time in almost 20 years, the responsible, adult, unsexy part of your financial life isn't just bleeding value to inflation. It's working. Not working hard, more like a reliable employee who shows up on time and never complains, but working. So emergency fund in place, in a high-yield account, earning real interest. Check. Now we can talk about the index fund. 90% into a low-cost S&P 500 index fund, 10% into short-term treasuries, exactly as Buffett described in his own will. The S&P 500 has returned roughly 10% per year on average over the long run. Here's what that does to your $10,000. In 10 years, about $26,000. In 20 years, roughly $67,000. In 30 years, around $174,000. In 40 years, nearly $452,000, almost $500,000 from one $10,000 investment with zero skill required, zero ongoing effort. You click buy once, and then you live your life. Now, I know what you're thinking. Those timelines are long. And yes, they are. But that length is literally the entire point. That's the moat. That's the thing that makes this strategy work while everyone else is trying to be clever and losing money doing it. Because here's the real destroyer of investment returns, and it's not picking the wrong fund. It's behavior. There's a research firm called Dalbar that every serious finance person knows about. Every year, they measure the gap between what investment funds return and what the actual investors in those funds earn. And the results are brutal. In 2024, the S&P 500 returned just over 25%. The average equity investor, 16.5%. Same market, same funds. 8 to 12 percentage points gone. Not from bad fund selection, but from buying high when things felt exciting and panic selling when things got scary. Investors have underperformed their own funds for 15 consecutive years. Think about that. You could literally pick a great fund and then sabotage yourself just by watching it too closely. And here's the number that should physically hurt you. If you had put $10,000 into the S&P 500 inches, 2005, and never touched it, you'd have roughly $71,750 by the end of 2024. If you missed just the 10 best trading days in that entire 20-year period, just 10 days out of about 5,000 trading days, you'd end up with less than half that, around $32,000. And the absolutely sadistic part, 7 of those 10 best days happened within 2 weeks of the 10 worst days. The market's biggest recoveries are hiding right next to its biggest crashes. The people who sold during the scary part, the people who thought they were being smart and protecting themselves, missed the bounce back every single time. This is what Buffett means when he says the market transfers money from the impatient to the patient. It's not a metaphor. It's a documented, measurable, 5 years running wealth transfer. And the only way to be on the winning side of it is to do the hardest thing in investing. Absolutely nothing. One more number before we get to the exciting part. Because fees are the quiet, invisible version of the same leak. Take your $10,000, let it grow for 30 years in a fund charging 0.03% per year, which is what the major S&P 500 index funds actually charge. You end up at a certain number. In a fund charging 1% per year, which is what plenty of actively managed mutual funds still charge today, you end up roughly $18,000 less. Nearly twice your original investment, silently extracted over 30 years for the privilege of paying someone to underperform a fund that does nothing. Buffett structured an entire decade-long public bet specifically to make this point, and Wall Street is still hoping you weren't paying attention. Low fees are not a minor detail. They are a core part of the strategy. Okay, now we get to the part that makes this whole video worthwhile, because everything I've told you so far is what Buffett says you should do. But what about what he did? In 1999, a reporter asked him about his early returns, and Buffett said something that the index fund crowd conveniently never puts in their videos. It's a huge structural advantage not to have a lot of money. I think I could make you 50% a year on $1 million. No, I know I could. I guarantee that. 50% per year. Guaranteed. His actual word. And at age 93, at the 2024 annual meeting, he essentially repeated it, saying that with small sums, he'd look at everything and he'd find something. So let's talk about what 50% compounding actually looks like, because the number sounds fun until you see it in action. Your $10,000 at the market's average 10% becomes $26,000 in 10 years. Fine. Your $10,000 at 50% per year becomes $576,000 in 10 years. Run it to 20 years, and you're looking at over $33 million. From $10,000, that's not a return. That's a different life entirely. So is he hiding the good stuff? Is the index fund advice some kind of gatekeeping to keep regular people out? No. And the reason why is the most important idea in this entire video. To understand the 50% claim, you have to look at what young Buffett actually did, not what people say he did. Not the version polished for inspirational content. What he actually physically did. At 20 years old, he found out that a Geico executive was working on a Saturday. He took a train to Washington, D.C. The building was locked. He banged on the door until a janitor let him in, found the executive, and spent 4 hours interrogating him about the economics of the insurance industry. Then went home and put 2/3 of his entire net worth into the stock. Not some of it, 2/3. Everything he had, basically. He made roughly 50% that year. In his 20s, he sat down and read the Moody's manual cover to cover. 20,000 pages. Tiny print. Every public company in America. He was looking for stocks so cheap, so completely overlooked, that the market had basically mispriced them by accident. And he found them. Companies trading at a price-to-earnings ratio of less than 1. Businesses worth more in assets than their entire stock price. He and a friend literally drove around rural Nebraska farm to farm buying paper stock certificates from farmers who'd been handed them decades earlier and forgotten they existed. This man was cold-calling cornfields. His partnership from 1957 to 1969 compounded at roughly 30% per year, while the Dow did about 7.4%. $10,000 with young Buffett in 1957 became around $160,000 by 1969 in 13 years. And he never really stopped. In 2004, a reference book on Korean stocks landed on his desk. 1 page per company. He read through it over a weekend, found about 20 businesses trading at 2 to 3 times earnings, and personally invested $100 million of his own money. The approach never changed. The problem is size. Berkshire Hathaway is currently sitting on approximately $397 billion in cash and treasury bills. They are one of the largest holders of U.S. government debt on the planet. When you are that big, when every move you make sends ripples through the entire market, the tiny mispriced opportunities that built Buffett's fortune become completely useless. If he found one of his old 1950s bargain stocks today, some $50 million company trading at 1 times earnings, and it went up 10 times in value, it would not move Berkshire's needle by a measurable amount. He wrote it himself. We have no possibility of eye-popping performance. He didn't get less brilliant. He just got too big to fit through the doors that made him rich. And this, right here, is the structural advantage Buffett says he envies you for. You can walk through every single door he hasn't fit through since the Eisenhower administration. But be honest with yourself, because Buffett is brutally honest about this. The 50% path requires what young Buffett genuinely had. Thousands of hours. Reading financial statements, not as work, but as entertainment. He said in interviews that you have to be in love with the subject itself, not just in love with the money it produces. It requires the psychological makeup to put 2/3 of your net worth on a single conviction. And it requires living and breathing this stuff the way most people live and breathe their actual careers. If that description fits you, the structural advantage is real. It's documented. And Buffett himself says he'd be doing exactly that if he were starting over small today. But if that description doesn't fit you, and for most people, it genuinely doesn't, and that's completely fine, then the index fund isn't the backup plan. It's the plan. The one Buffett trusts with his own family's money over every hedge fund, every stock picker, every Wall Street genius on earth. So here's the whole video in one final breath. Step 1. Any high-interest debt goes first. Guaranteed risk-free return. No contest. Step 2. Emergency fund in a high-yield savings account. 4 to 5% while you wait. Done. Step 3. 90% into a low-cost S&P 500 index fund. 10% short-term treasuries if you want to copy the will exactly. Step 4. Keep adding every single month, rain or shine. Mark it up or down. Step 5, and this is the hardest one. Do nothing. Not when the market drops 40%. Not when your coworker says he found the next big thing. Not when every news channel says this time is different. The math doesn't need you to be brilliant. It doesn't need you to be lucky. It doesn't even need you to be right about anything. It just needs you to stay. The greatest investor alive, at 95 years old, sipping his fifth Coke of the day in the same house he bought 65 years ago, would tell you exactly the same thing. If you found this useful, hit subscribe, because we break down exactly this kind of stuff every week. No fluff, just the real numbers behind the decisions that actually matter. I'll see you in the next one.